In today's video, we're going to take a look at WP Carey, ticker symbol WPC. This is the 16th video that's a part of my portfolio series where I'm doing an in-depth analysis on all 32 stocks currently in my own portfolio. If you're new to my channel, my primary focus is on income investing and also dividend growth investing with holdings that offer at least a 4% yield. As I'll say in every video in this series, this isn't done in any particular order, so just because this video is 16th in this series does not mean that this is my 16th favorite stock or my 16th largest holding. Also note that because I own all these holdings, I am biased towards them, so do your own research before making any investment decision for yourself. Also, let me know if there's any improvements to this series that I can make going forward. Feel free to check out last week's video, which was on Ares Capital, ticker symbol ARCC, which is my favorite BDC and my current favorite income holding. Going on to my Vanguard account, which is where I do all my dividend investing, as of the making of this video, I currently own 83.873 shares of WPC stock. Their stock pays quarterly dividends, with their last being for $1.06 per share. With the number of shares that I own of this stock, I receive roughly $89.66 every quarter, or divided by 3, which is what I like to do, that comes out to roughly $29.88 a month from this stock. WP Carey is one of the largest diversified REITs in the world, specializing in the acquisition of operationally critical, single-tenant properties located in North America and Europe. Celebrating their 50th anniversary this year, this company owns more than 1,400 properties with an occupancy rating of 99.2%. They create custom deal structures to address the unique needs of each seller through sale-leasebacks, build-to-suits, and acquisitions of existing net leases. WP Carey typically invests in properties that are occupied by a single tenant and are classified as industrial, warehouse, or select retail. This company is currently my second favorite real estate investment trust behind Realty Income. Although it doesn't offer monthly dividends, this REIT had a solid track record of stability and currently offers a higher yield than Realty Income. Their stock just recently became a dividend aristocrat after growing their dividend for 25 consecutive years. Let's start by taking a look at their property portfolio. WP Carey likes to target properties that are considered operationally critical and more recession-proof. This includes properties like government offices, self-storage properties, schools, and warehouses. According to their latest investor presentation, WP Carey currently owns 1,446 properties with 397 tenants. 62% are located in the US, and 36% are in Europe, and 2% are elsewhere. They have an occupancy rating of 99.2%, which is far better than the average REIT. The most recent data that I could find shows that the average occupancy rating for industrial, retail, apartment, and office sector REITs were 96, 95.8, 93.7, and 87.5% respectively. This company has an average WALT or weighted average lease term of 10.9 years, which is also better than average. The longer the WALT a REIT has, the better, because you want to be able to lock in tenants for as long as possible, which helps predict cash flow. 51% of their properties are classified as being industrial and warehouses. 17% are retail properties, which according to their website are specialty retail stores. These are business-to-business wholesale and do-it-yourself retail stores, which fare better during all economic conditions compared to, let's say, electronic or factory outlet stores. A lot of the office properties that they own are also considered operationally critical, which includes 70 government office properties in Spain. Self-storage properties can also be good investments regardless of the economy, since people will always need a place to store their belongings. WPC's dividend history is pretty impressive, although there is one downside to it. You can see that they've grown their dividend every year since 1998, officially making them a dividend aristocrat. What's also really impressive is that WP Carey has grown their dividend every single quarter since April of 2001, which is exceptionally rare. The only other company I can think of that's been able to successfully grow their dividend every single quarter for many years is Realty Income. But while that is impressive, what hasn't been is this stock's dividend growth, which has been slow for many years. Just by looking at their more recent dividend payouts, we can see that they have a habit of only increasing their dividend by a fraction of a penny each quarter. They used to have some pretty sizable increases in the past. Like you can see between 2011 and 2014, there were some really impressive gains in their dividends, but this hasn't happened for a long time. In the last few years, their dividends have only grown by a few cents per year. Although it has been growing, it would be nice if we could see some more growth coming from their dividends. Their 5-year dividend growth rate, according to Seeking Alpha, is only 1.03%. Realty Income's 5-year dividend growth rate is nearly triple that amount. But still, WP Carey is currently one of the highest yielding dividend aristocrat stocks, and their distribution is still very healthy compared to some other options that exist among aristocrats. Just like a lot of my favorite dividend stocks, WP Carey has a long history of beating the market when dividends are reinvested. Running it through a drip calculator, since 1998, WPC has consistently beaten the S&P 500 in total returns. A $10,000 investment in WPC 25.5 years ago would now leave you with $178,418 compared to an S&P 500 index fund, which would have given you $72,500. WPC's average annual return during that time was 11.96% compared to SPY's 8.08%. To put these returns into perspective, in January of 1998, WPC was paying a dividend of about 41.25 cents. That means you would have received $189.33 a quarter back then for your investment. Fast forward to today, you would now have 2,477 shares of WPC, and you would now be earning $2,647.91 every single quarter from this stock. WP Carey is also a triple net lease REIT, which is my favorite type of REIT. This means the property tenants and not WP Carey are responsible for paying taxes, maintenance, and insurance. As you can imagine, this saves the company a lot of money, and a lot of other REITs that own apartments, malls, and infrastructure don't typically have this same luxury. The money that WP Carey isn't spending on these things can instead be used to acquire more properties or pay more dividends. According to Hoya Capital, there's at least 18 triple net lease REITs, including Realty Income, National Retail Properties, Agree Realty, and Spirit Realty. Many of these REITs have pretty solid track records in terms of growth. More recently, WP Carey stock has gotten beaten up, which I know has some people concerned. All throughout 2022, WPC was a stock that defied the stock market. While the S&P 500 was falling, WPC was actually growing during that time. But then starting in February, their stock recently started to fall, and as of the making of this video, it's currently down almost 8% for the year. I don't know why exactly the market recently became bearish on their stock. It might be because of its office properties, because a lot of other office REITs are also down. But as we covered, I think that's pretty ridiculous because they only make up 17% of their portfolio, and they only invest in those operationally critical offices. This has included government office buildings and company headquarters. When WP Carey acquires office properties, they make sure that they really are operationally critical. Regardless of whatever the cause for their share price falling is, there's still plenty of good reasons to not run away from this stock. They just became a dividend aristocrat, and they have decades and decades of solid growth and management. Looking at their most recent financial statements, we can see that their funds from operation for Q1 was $1.29 per share for the quarter. Because their last declared dividend was for about $1.07 per share, this means that their dividend payout ratio was 82.9%. That's a very healthy payout ratio, and it shows the dividend is completely safe at this point. What I also think is really impressive with this company is their same-store ABR growth. This indicates the properties that WP Carey owns are so desirable that they're able to increase the rent on them at a pretty good amount. As of first quarter of this year, their same-store ABR growth was 4.3%, which is better than a lot of other REITs I've come across. The way that they're able to raise rent on their leases is by having built-in rent escalators. This means that when the property owner agrees to sell their property to WP Carey, they agree that the company can regularly increase the rent that they have to pay. Not all of the company's leases have this agreement with their tenants, but the more that they can negotiate this, the better. To summarize, I think we've gone through plenty of good reasons as to why WP Carey is a solid dividend investment. Although it doesn't have a high growth rate and it doesn't pay monthly dividends, it does have a solid property portfolio. What they own are properties that I would even consider to be more recession-proof. If I had to choose only 5 dividend stocks to live off of for the rest of my life, then WP Carey would be one of those 5. I believe this company can withstand even serious recessions just like they did back in 2008 without cutting their dividend. But with that being said, that's going to wrap up our look today at WP Carey. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. You'll also have the option of reading this analysis as well as every other analysis that I do in this series. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.